Investing hinges on understanding the data, but these days it also means divining what the Fed's gonna do next. So, what did Fed Chairman Jay Powell have to say before Congress? And did the markets actually hear what he was saying? Next on our episode of Cocktail Investing.
Hello, welcome to this episode of the Cocktail Investing Podcast, where we look to bring context, perspective, and understanding to all the data that is around us each and every day. Some would say, and I would agree, we're looking to distill investing signals using our thematic approach here at Thematica Research. And I am Chris Versace, Thematica's Chief Investment Officer, also kind of your steward of the show. But joining me, as always, is my right-hand person, couldn't do it without her, Lenore Hawkins, Thematica's Chief Macro Strategist.
Hey. Yep.
It's so funny when we do this that sometimes I'm in like a little routine and it just flows out. And other times it's just kind of like, oh, I got to say this now. It's just kind of funny. Anyway, we got a packed show as we said on the quick little intro. We do have to understand the data. There is, of course, no shortage about it. But taking center stage this week, Lenore, is Jay Powell. So let me get the usual housekeeping items out of the way, and then we'll talk about what Jay Powell had to talk about. So as we get ready to get underway, check out thematicaresearch.com. If you go there, you've got all the background on our investing themes. You can catch our thoughts on the markets, sign up for Lenore's free weekly wrap, which is winning all sorts of accolades. You can get the Monday morning kickoff. And for those people that are more active investors, we've got our Thematica Investing Select List. You can see what we're recommending based on our investing themes. You can check out how we're doing. And hint, hint, wink, wink, nudge, nudge. It's I have to say it's pretty good. So with that,
if I do say so myself.
What the nice thing about that is, I've been doing this a long time, and there are people who love to pat themselves on the back, and there are people who do it, surprisingly and do it well. But the market, as we all know, is the greatest humbler, and the results, as they say, speak for themselves. So with that, I'm going to say, wow, this is quite the week. We've got a lot of data coming at us. We've got retail and restaurant earnings as well. And inside those earnings, we're seeing both our connected society and our cash trap themes at play here. Connected society, of course, the increasing shift towards digital commerce, cash trap consumers. You'll hear a lot about this on the program today, but consumers that are drowning in debt, not seeing any wage growth, having to trade down. It's really impacting where they're buying or if they're buying. So we've got all that going on. And like we said, or just teased a minute ago, we've got the debut of new Fed Chair Jay Powell, as he does what Fed chairs do every so often. This week, he testified before Congress. And the thing about this is it's about 3 weeks until the Fed's next monetary policy meeting. So, of course, Lenore, people are hanging on every word.
They really are, it says a lot about how the relationship with the Fed has evolved over the years with the economy. I mean, there was a time where people didn't even know who the Fed chair was, didn't care. Yeah. And now every time the Fed speaks, just, oh my God, what did they say? And dissecting, wait, was there one word a little bit different in the FOMC meeting minutes this week?
Yeah, I'm just trying to figure out, though, if, in hindsight, if Janet Yellen and maybe even Jay Powell going forward, is he more rock star to the markets, or is he becoming Punxsutawney Phil? I'm not sure.
I think they're getting really nervous because with each new Fed chair, the markets have to wonder, is this guy or gal going to maintain the tradition that I pretty much started with Alan Greenspan, where the Fed kind of finds itself, believes that it's supposed to provide kind of a put to the market. And there's that.
Now, hang on. Just for the average listener, when you say a put to the market, what do you mean?
That if the Fed sees the markets getting wobbly and stock prices starting to fall significantly and or bond yields starting to rise a lot.
It would be kind of like what we're seeing.
The Fed intervenes, right? And that's what we started seeing that with Greenspan, because Greenspan, it started off with Greenspan more about the economy because he was the great moderator, right? Greenspan believed that he could almost free us from the business cycle of it. If you
Hmm.
managed monetary policy just right, you could keep the economy indefinitely expanding and we wouldn't suffer a recession.
And how did that work out?
Yeah, not so well. It turns out you really can't fight nature. And there's the seasons. You've got the booms and you've got where things have to kind of you have to winter where you weed out the weak. It just the companies that got funded that shouldn't have gotten funded, they need to fail, right? We need these cycles. But he
Some
did
of some of
manage to
some of those Bitcoin offerings shouldn't have been done.
yeah, some of them shouldn't. But we moved from this belief that they needed to really manage the economy into now the markets. And I think this being the first time that Powell was in front of Congress, people were going to see, what's he saying about the stock market? And I think you and I weren't terribly surprised. We expected that he was going to be a bit more hawkish than Yellen. What was really funny to me, though, is of all the days, the first time that Powell decides, or not decides, but the first day that Powell is scheduled to testify in front of Congress, that really, of all days, that's the day that Bernanke, the one two Fed chairs ago, Bernanke interviews Yellen at the Brookings Institute. I mean, what the hell? Is this some sort of Fed chair version of a Kardashian, hey, pay attention to me now move?
It is tough when the spotlight is suddenly no longer focusing on you, or so I'm told. So it is surprising though that it happened on the exact same day, and supposedly Powell and Yellen are kind of simpatico. So you would think I'll be respectful to my pal, let him do this.
Yeah,
you know what I mean. So it is a little
strange
surprising.
Move. It was a very strange move.
Well, let's talk about real quick on the market, and then I want to dive really into what Powell had to say because one of the things that we do, you and I, in our daily work, is we try to really understand what's going on, and that's kind of part of what's key is understanding what's being said and understanding how people are interpreting it, because sometimes what is said is not really what's heard. So why don't we talk real quick about the market? I know that you were saying that there's a lot of risk back on in the market. Let's talk about that real quick.
When we started on the week started off with it was a very much a risk on kind of thing. We're back into the races, and all the major indices are moving on back up. But what we've been noticing is the volume on the ups is nowhere near what the volume was on the downs, right? And that's, you never like seeing that because that's not a confirming data point, right? We're always looking for that. You want to see moves up on increasing volume because that's like, all right, all the participants are going, yes, we're in and we're moving up.
Volume one way or the other is very confirming.
Very confirming, exactly. We also saw some strange things like Friday when the market really ripped up. We saw that small caps lagged. That's also not a confirming. If when it's only the big boys that are doing well.
So you would see that just when you say small caps, the best proxy for that's going to be the Russell 2000, right?
Exactly. Utilities, most interestingly to me, utilities were a top performer, and the utility sector outperformed the more cyclically sensitive transports on.
Sorry, I just want to cut you off because they have not been performing well of late, right? Given yield concerns.
But on Friday, they did. That looked really strange to me. Right. And you've probably heard people talking about margin debt. And it's interesting to me to see that there's been this attempt to kind of say that the margin debt doesn't really matter, right? Because margin debt's always very concerning when you see a big run up in margin debt, because then that just means the market's going to be more volatile. Because if you've borrowed money to buy those stocks, if the stock price goes down, that's very painful.
Yeah,
I end up getting the margin calls where you have to sell.
Yeah, I can't say I've been there personally. However, I will say that there was a phenomenal article. I think this is Wednesday as we're taping this. I think Monday or Tuesday, front cover of the Wall Street Journal, that was talking all about that and how we've actually hit record levels of margin debt, bigger than we saw back in 2000.
So right now, the kind of argument against that being meaningful that's been thrown out there is that if you look at margin debt relative to market cap, it's actually not bad at all. Now, the problem with that
seems like a BS metric.
Yeah, you think? Because the problem with that is if I borrow and the stock price goes up, and then I borrow some more, and then the stock price goes up, and then I borrow some more, and the stock price goes up. And with that logic, you can go infinitely as long as the market keeps going up. Because if the stock price is going up, well, that's how market cap grows, right?
Mhm.
So if you've got a market that's insanely overvalued, like PE ranges at the levels we've never seen before, you're also going to have market cap really, really big, right? And so looking at margin debt as a percent of market cap, to me, it's worth looking at it, but it really doesn't tell the whole story. What I like to look at is relative to GDP.
Yeah, just let me get a quick thought in on margin debt relative to market cap. So you can have the exact same outstanding margin debt in absolute dollars, right? And all of a sudden we see the market get a little freaky like we saw in February, and then all of a sudden that percentage
Yeah, it doesn't look
changes
so bad.
wildly. It changes
Yeah, it
wildly.
drops.
Yeah,
Drops. And so it doesn't really, I mean, that's using that logic that margin debt as a percent of total market cap, if that's your metric, then you could have PE ratios go up 100-fold, and it would everything's fine. And
yeah.
it have 100-fold increase in PE and have margin debt go up like crazy, and it's supposedly fine. So I found that a poorly made argument, but that's one of those that's been out there. If we look at margin debt as a percent of GDP, it's definitely in some concerning areas.
Okay. Okay. But yet, the economy, if we look at the data we're getting, is it improving in your perspective? And I know we're going to get a little more into this,
Yeah.
but is it on the right path?
I think, well, we do see signs. It's a mixed bag. There are some signs that the economy is improving. There's some other signs that are like, it's not really looking. It is not a clear picture of an improving economy. One of the things I would point out is, in particular, people are looking for CapEx, right? They're looking for businesses to invest back in themselves. And one of the reasons everybody thinks that this is really going to accelerate is because the tax treatment, right? You can fully expense for the next 3 years, and that will really jack up capital expenditures. The problem with that is, you and I talked about this a lot before, is looking back at what happened with the Cash for Clunkers program. If you induce people to do something that, say, over the next 5 to 10 years, I would make these investments. But if I've got this huge tax advantage doing it earlier, chances are I'm going to pull that forward, right? So what we're doing, potentially, I'd argue, we may be seeing a lot of capital expenditures being pulled forward, being pulled to today, to this year and next year, that we would have had years later. Now, why that's really concerning is, if we do, at some point, we're going to have a recession. It's going to happen.
Yep.
When that does happen, if that were to happen in, say, 18, 24 months, would it possibly be even a deeper decline because the CapEx that we would have had in those years got pulled forward, which is kind of what we saw with Cash for Clunkers, where, car sales were doing great and then they crashed.
Yeah, I mean, we're anytime there's a pull forward in demand, we see that. We saw that with auto sales again coming out of the hurricanes that we saw last year. But it's interesting, and I try not to be a conspiracy theorist, but did you notice that while this whole CapEx conversation is going on, Trump announced the head of his reelection campaign yesterday?
Yeah.
Pull forward demand strong next couple of years. Reelected.
Done.
So, all right. Well, let's set the basis for this conversation about what new Fed Chairman Jay Powell said in front of Congress yesterday. So to do that, I just want to set up, what are the prevailing narratives that are out there? We've got tax reform, we've got reduced regulation.
Right.
We
so
talked
less
about
hostile environment. One of the big ones is that there's a lot that under Obama, this is just the narrative, under Obama, DC was more hostile towards business than the current administration, and that has taken those in the C-suite from being very concerned and very conservative about future prospects, because they weren't really sure what new regulation was going to be coming out of DC, that now they're a lot more confident that there isn't sort of this, I think the phrase that's been tossed around is the war on business, that has stopped.
Hey, Trump's not saying you didn't build this.
No, exactly.
If anything, he wants people to build
more.
Yeah. All right. So we have that. The other aspect of it is tax cuts. Will they spur higher wages. Will this lead to inflation? And then, of course, as you were talking about, there is the Fed's put on the market. So those
Yeah,
are kind of
there's an assumption that if we get a real pullback in the market, the Fed would step in. And that, I mean, we got to think about how impactful that has been on the market, because you have people who've just been in the markets for, say, 10 years,
Mhm.
and they've never not seen that.
Oh yeah.
And that, the buy the dip. Well, buy the dip is because everyone thinks that the Fed will step in. I mean, that's one argument, is that people think the Fed's going to step in. So you know what? The Fed doesn't even need to step in, because if everyone thinks the Fed's going to step in, the Fed doesn't end
Right,
up
right,
having to
right.
step in, right?
Self-fulfilling.
Exactly. But if that really gets questioned, then a dynamic that an awful lot of market participants have lived with, and it's the only thing they know, is going to be dramatically changed.
So let me just ask you this: when you say the Fed intervenes, right? We know that the Fed can do a number of different things on the monetary policy side, but and this is my bridge to Jay Powell's testimony that we're going to break down a little bit. Sometimes they just have to choose their wording very carefully.
Yeah.
And the market will, because sometimes they're sitting on pins and needles. What are they going to say?
Yeah.
They can react based on the wording. So I know you've done this. I do this. I really prefer to read the transcripts of what the Fed chairman and women have to say, so I can really understand and parse the language. Because I think if people just hear it, they're just like in conversation, and this to be true. Sometimes when you're talking to people, maybe this has happened when you're talking to me. I doubt it though. The listener just hears what they want to hear, right?
Correct.
You know what I'm saying? So with that, let's start to break down what Powell had to say and offer some context and perspective around it. Because, again, Powell is saying certain things, but we need to understand exactly what is going on to put some context and perspective around them. So let me start off, and this is a direct quote from Fed Chair Jerome Powell. Quote: We've seen continuing strength in the labor market. We've seen data that will, in my case, add some confidence to my view that inflation is moving up to target. We've also seen continued strength around the globe, and we've seen fiscal policy become more stimulative. So I read that, Lenore, and channeling my inner Lenore Hawkins, chief macro strategist, I said, well, what? Because if we look at the data, right, even just some of the data we got this week, that data is not really pointing towards a vibrant, firing on all cylinders economy. Now, is it?
No, like we said, it's kind of a mixed bag. There are some signs of strength. Like, for example, the Dallas Fed manufacturing did come in stronger than expected, and the inflation index for that report was the highest we've seen since May of 2011. So yeah, that was strong. But if you look at the Chicago Fed National Activity Index, now that views the whole country. It actually surprised to the downside and was at the worst level we've seen in the past 5 months. And in that report, we've also seen the breadth of the data is starting to decay. So it's not super straightforward. The Citigroup Economic Surprise Index fell below zero. Now, when it's above zero, that means that the data coming in is better than expected. Exactly. And it was doing really well for about 18 months. It's been above zero, and it just dropped below zero for the first time.
Well,
So,
if we look at some of the data too that we're just getting this week, it sounds like that Citigroup Economic Surprise Index, abbreviated the CESI, is probably poised to go a little lower. I say that because for December and January, new home sales disappointed, falling far greater than expected. Durable orders that we just got the other day for January, weaker than expected. They came down 3.7%, and the consensus was for a fall of 2%. So it sounds like, this mixed bag that we're talking about, I think to you and I, we would agree, yeah, we're probably going to be around the same level of growth that we've seen, not really seeing a big acceleration. So not really sure what Jay Powell is seeing in the tea leaves just yet.
Yeah. I mean, I see too many, like you said, we're not saying a recession is not around the corner.
No,
it's
absolutely
not coming.
not.
We're not saying that. It's just, geez, you're not looking around and going, oh, wow, that's a good one. There's another good one. There's a fantastic report. Oh, sweet. Game on. We're seeing a lot of, ooh, that was a miss. There's another miss.
Well,
and when he says that the continued strength in the labor market, think it was just last week, we were talking about how in the latest Bureau of Labor Statistics report on real earnings, the 82% of the labor force that's in the non-supervisory and production staff, they saw their wages grow all of, I think it was 0.8%.
Yeah, small.
Yeah, 0.8% year over year. I mean, really, we're calling that continued strength in the labor market. And we'll get into this a little bit later too, because there's a variety of reasons behind why we're not seeing a whole lot of upward wage pressures. And I think one of my frustrations is I think that's not being discussed, that maybe there are some structural reasons that we're not seeing wage pressure. And if there are, which I suspect there are structural reasons for that, then you're not going to see wages move the way they have in the past.
But we'll get into that. So let me just tie up this one avenue that we're talking about here about all this economic data. So from a thematic perspective, we kind of dive into all of this for our economic acceleration, deceleration theme. And I think, in that lingo, we are seeing the economy continue to move forward. As we said, we don't see a recession coming around, like you said. So it's kind of
not in the immediate. I mean, we're not in the next, and recessions are so nobody has been able to accurately predict recessions, like a year out.
They make weathermen look good. We know that.
Exactly. But what we can say is we don't see indications that it's going to happen in the next 3-6 months.
Near term.
Yeah, not near term. Now, but what could happen within 2018? Can't tell right now. Things could change.
All right. Well, that's why we keep reading the data, right?
Exactly.
Okay. All right. So let's move on to Powell's next statement. And this is direct quote. The labor force participation rate remained roughly unchanged on net as it has for the past several years. That is a sign of job market strength, given that retiring baby boomers are putting downward pressure on the participation rate. And I thought about this, mathematical equation, Lenore, that you shared a little while back that I think some people tend to forget. It goes something along the lines of GDP equals productivity times employment, right? And
it's a function. It's the growth in the economy is dependent on the growth of the labor pool and improvements in productivity. So if you get like a 1% growth in the labor pool and you get 2% improvement in productivity, GDP can go up 3%.
All right. So what happens then if the non-farm business sector labor productivity falls, I don't know, 0.1% during the fourth quarter of 2017?
Exactly. Yeah.
So kind of a headwind, is that what we're saying?
Yeah, exactly.
Okay. All right. So then the other one is this little nugget.
But let's also point out that his statement is, I would argue, kind of misleading, because there are a couple participation rates that you can look at. And yes, you could say that the participation rate for the entire society, right? Because you're going to have more and more people, because a bigger portion of the population, that you would expect to go down as you have a bigger portion of the population is over 70. So yeah, it would make sense. Okay, then riddle me the labor force participation rate for people who are 25 to 54. That's the peak. That's the peak. Well, we haven't seen where that has returned to the levels that we had pre-crisis. It has been trending down. Like in October of 2008, it was at 83.4%. It bottomed out in July of 2015, but it still hasn't come anywhere near where it was in 2008. It's like 81.7 right now. So we're still well below historical norms.
So I guess the question is, when we look at this data, why aren't people coming back into the labor force and looking for work?
That is a very big question. And that is one of those things that I think is part of some structural changes that we've got in the economy. I mean, one of the things that we've seen, if you break it down a little bit more, is the labor participation rate for women has actually done pretty well. For men, it's been trending down for a couple decades.
Yeah. I mean, I hate to say it, but if you're a white guy, middle-aged, things are not looking good for you.
Well, and there's some really tough things that are going on in the way the economy evolves that used to be that guys, if you didn't get a great education
Hmm.
and you didn't have, those white collar skills, you could always find a decent job in manufacturing.
Absolutely.
In
Absolutely.
some, you could find a great job in using your body, using
Excuse me.
construction,
Oh, thank you.
truck
Thank you.
drivers. You could
Mhm.
find something that was more that that was more about
Well,
physical labor, and we're seeing that decline more and more, and that kind of retooling. Now the challenge, and I can understand why Trump really wants to defend and put up these barriers to protect domestic manufacturing, to keep, to grow some of those jobs.
mhm.
The problem is, around the world, those kinds of jobs, as technology improves, those kinds of jobs are just fading. So you can try and fight just the reality of an evolving economy and disruptive technology.
Mhm, mhm.
You can fight it, or you can deal with it and try to be ahead of the curve instead of trying to fight the inevitable.
I think that's right. I mean, I talk all the time with people about how certain jobs, as a result of our connected society and disruptive
Exactly.
technologies, they're just no longer around. Like, and I tell younger people, I go, when I was working at Solomon Brothers in like '92, right? So a long time ago, if you wanted SEC filings, you would have to call the library up. They would have to copy them and mail them to you.
Yeah. Those jobs don't
Today,
exist.
no, they don't exist.
No.
I'm sure you remember, around that time frame, like, sensitive legal documents, and whatever, messengers don't
Hmm.
exist. And the same is true to your point, on the shop floor. People used to be able to work their way up, be a shop floor
Yeah,
manager. Those jobs are
that
gone
doesn't.
because of productivity and technology.
And it's a really tough thing, in a couple of ways. And then, on the other side of the spectrum, you have, so this isn't about cryptocurrency. This is about the blockchain technology. You have a massive demand for blockchain programmers,
Mhm.
where, you could be 20 years old pulling down a couple $100,000 a year, and they can't find them. There's just not enough. Right? So it's a real evolution in the economy. And I think one of the things that's actually going to be tough too on a global level is, you used to have where emerging markets, and this happened with China, where an emerging economy that was mostly kind of sustenance farming, agrarian,
Mhm,
they
mhm.
could move out of that into the more developed economy, improved per capita wealth dramatically,
Yep.
just by
Yep.
taking people out of the farms and bringing them into factories, and bit by bit people start developing skill sets. One of the ways like China did it was through garments. And now you've got a disruptive technology and you're seeing this in India right now, where rather than having these people start to learning kind of like manual skills, and then, like you said, working their way up and developing skills as a society, that's getting leapfrogged with the robotics that are able to do that sewing. So it's, what is going to be the path
Right.
for these struggling economies? Because what has always worked in the past isn't really going to work that well anymore.
This is similar to another aspect of our disruptive technology that we tend to talk about. It's, when you look at, the US and the infrastructure we have, whether it's for banking, for telephone, electricity, what have you, look at the emerging markets, they're leapfrogging
Yeah.
us because they don't have to contend with that existing infrastructure. Again, this is the example that most people tend to cite. I think it's worth saying. Telephone lines just go straight to
Yeah.
mobile. So
Yeah.
same idea. Okay. All right. So let's move on. And this is the one that I know we're going to talk more than a few minutes about. This is my this is so funny. Again, quote from Jay Powell yesterday when he was talking to Congress. Quote: "We continue to view some of the shortfall in inflation last year as likely reflecting transitory influences that we do not expect will repeat." Now,
Okay,
before
seriously, if
hang on,
I
hang on,
if
hang
I
on.
had a dime for
Before
every transitory.
I was just going to say, before you say anything, let me just point, because it's going to be like an economic trip hammer here, folks. So let me just point out that they have been saying this for more than 2 years.
Oh my god, how transitory is the new permanent.
I'm trying to think about what that means, but I think that is the case. I think that is the case. So, we've talked, I mean, quite a bit about this, and I think I'm just going to rattle a couple things off that I think are giving way to this, and then I want you to weigh in. So, with our connected society thing, we've got digital shopping, the ability for people to price compare, forcing companies to be competitive on price. We've got oil, which we've seen. I was on the Heat last night, which is a Chinese program. They were talking about the U.S. potentially having its greatest level of oil being exported 2018 in all time.
Yeah, that's a disruptive technology has really changed the dynamics of the global oil industry.
Right, right, and and there are other factors out there.
Well, and
Uh,
with your digital shopping, I mean that's our connected society
Correct.
has created a massive deflationary force in that it is much more difficult for retailers to increase prices because it's almost costless for a consumer to compare prices. And since so much is done online in that connected
Hmm.
society,
Hmm.
I'll buy it from whoever gives me the lowest price.
Yeah, I mean, it used to be you would go to the mall, you might check two or three stores. Who's got the best price? There.
Yeah.
All right, I'm paying. But
It
now,
cost a lot to compare prices.
absolutely true. Both actual time, which is
Yeah.
money, as we know, and actual money, gas, and whatever.
Yeah.
So yeah, absolutely, absolutely. But other than those two, are there any other demonstrative forces? I know in the past, in keeping with our aging of the population investment theme, you've talked about how we're seeing the graying of America have a downward pressure on prices.
Right, because when you have the bulk of the population is moving into a phase in life where they are not accumulating assets, they're actually starting to maybe liquidate those assets, right? As people retire, they're maybe downsize their home. They're a lot less likely to buy a new car. They're not furnishing a new home that they're going to fill with kids,
Hmm.
right? They're not buying as many clothes. Somebody in their 30s just buys more clothes in general than somebody who's in their 80s.
Does that explain why when I go to my dad's closet, he's 86 years old, by the way, that I see the same Hawaiian shirt when I was a kid?
Exactly. And that has a significant downward pressure on the markets. But one of the other things that we see that has really kind of structurally changed is you have more and more sectors are becoming more monopolistic, not
Hmm.
monopolistic with a handful of very, very large companies. And when you see that, you tend to see wages not move up as much because those handful of major employers in any particular area, they don't have to compete as much, right? If you've got 100 different companies that you could go work for, it's a very different job market than if you have like three competing for you.
Yeah, I totally agree on that. I totally agree on that. So let's see, what did Jay say next? Um,
Spending.
oh yeah, here it is. Here it is. Here it is. This is the one that gets me. Um, the strong job market and recent corporate tax cuts will boost consumer spending. Now, this is right in the wheelhouse of our cash-strapped consumer. I'm just going to rattle off a couple of stats, and then we can talk a little bit about it. Because I think I would speak for us, Lenore, when I say, yeah, we don't see that. And here's why. So, the New York Fed Center for Microeconomic Data, their most recent quarterly report on household debt and credit revealed that total household debt, hang on to your seat, Lenore, reached a new peak in the fourth quarter of 2017, hitting $13.15 trillion dollars. That's unbelievable. And I know we like to break our data down, make sure we're corroborating it. So I went over to one of my favorite websites. It's also one of the scariest websites on the planet,
It really is.
usdebtclock.org. Personal debt there, $18.85 trillion dollars. And that's everything from mortgage debt, student debt, and credit card debt. And if you break it down, because again, context is key, personal debt per citizen clocks in at $57,609.
Yeah.
Unbelievable. But here's the thing, what's the average median income? Do you remember? Do you know?
Yeah, nowhere near. And that's income like for the whole year.
Yeah, it's around like
So,
30. It's here it is. It's right
yeah,
around, it's just over $31,500, relatively unchanged in
yeah,
18 years.
yeah.
So
Well,
I just,
we've talked a lot about how everybody gets all excited about seeing the consumer spending. I actually get real nervous. I don't like seeing consumer spending grossly outpacing increases in wages because the only way they're able to spend more is to borrow more. And
yeah.
that's just borrowing. Borrowing is just taking away consumption from the future.
Absolutely. And if Jay Powell stays on path with the Fed and monetary policy, he's going to make it that much more expensive.
Yep.
For folks. I mean, we've talked quite a bit about this over the last couple of weeks. It's a big concern of ours. It's a huge potential tailwind to the economy throughout 2018, 2019, and this really centers in on our cash-strapped consumer theme. When you're riddled with debt, your wages aren't growing, you're going to trade down, figure out ways to stretch those dollars. You may not be out eating out as much. You may not be buying those UGG boots in the winter, but you might have to do something. So,
well, it kind of, I think it that idea was really reflected when he was asked about the stock market, how he feels the relationship with the stock market. And let's first, Bernanke was very clear that he believed that lower bond rates and higher stock prices were very stimulative to the economy. And so he thought it was the Fed really should kind of help do that because of the wealth effect. Exactly. Right. So that if you see your portfolio going up, you're going to spend more. Now, we'll just put aside that, what is it, over, I think it's like 83% of all stocks, bonds, and so on are owned by like 10% of households. Yeah. So that wealth effect is highly concentrated, but we'll put that aside. But that was Bernanke's view. So you could kind of, and Yellen had kind of a similar view. They were both proponents of the wealth effect. Well, in contrast, yesterday, Powell said that the stock market is not the economy, although it does play a factor. That's kind of paraphrasing. So he's taking a bit of a step back. He doesn't feel that he is to be a steward of the stock market quite the way I think Yellen and Bernanke believe they were.
I think my response to that is we will see.
Exactly. We'll see. And I think that was one of the things that got the markets nervous.
Okay. So I think if we were to paraphrase all of it and take a look at it, the market did get a little skittish. To your point, there,
it did.
When they looked at everything he had said, the reaction is very quick. I mean, you can look at a daily chart, and you would have seen it yesterday. He talked, and as he did, the market got a little weak, and towards the end of it, he was a little more hawkish. To your point. And what happened? The Dow fell 300 points.
Yep. The S&P closed down about, I think it's 1.3%. Treasury yields jumped up. We're seeing a flatter yield curve. Dollar strengthened. And VIX jumped back up, about almost a 20% increase in the VIX.
All right. So
volatility is back.
So let's kind of put our spin on this, our answers, if you will. My view on this is Powell was there, first testimony before Congress, first public unveiling, kind of largely in the playbook, put a little bit of his own spin on it. But I think that the market did not really hear or think about, more importantly, what he was actually saying versus what is really going on. So he was talking. I don't think the market understood what he was saying with context and perspective. I say that because one of the key takeaways that I read was, and this is a quote, the basic takeaway is not complicated. The likelihood of moving to a 4-hike baseline in March has gone up.
Yeah, I think it hit like 38%. The market's pricing it at about 38%.
Yeah, so that's what the market heard, and we have to remember too, in their context and perspective, is something you actually really pointed out a while back. The Fed tends to be cheerleaders for the economy. They're not going to get every Debbie Downer. No.
Yeah, you can't. You're not going to have Powell come out and go, "Damn, it's really bad."
Right.
But he did, and he did say that the tax cuts are stimulative, and he did make it very clear that fiscal policy has gone from being a headwind to a tailwind.
Absolutely true. But then he also said that the Fed is only going to raise its benchmark interest rate more quickly if it sees inflationary pressures. And we're not really seeing those. So it's hard for me, when we talk about the CPI, the core CPI, and other wage data, we see oil falling. We're not really seeing those inflationary pressures across the board. Even Powell had said, as we joked about, that elusive temporary measure seems to be the new norm. So it seems to me that the market kind of heard what it wanted to hear, right? Oh, there could be a risk of 4. Oh, Powell is saying it could be more like 4 rate hikes. But I don't know that he actually said that.
But doesn't that actually also say an awful lot about the state of the markets? The
Very
difference
jittery.
between three hikes and four hikes, like really? I
Yeah,
mean,
yeah, yeah.
you're just going to completely lose it because of four instead of
Well,
three?
that's very Warren Buffett of you when we look back to his annual shareholder letter, which was kind of talking about that.
Yeah,
That it,
it's so evident that the stock market valuations are really dependent on these super low interest rates. Both, I think, two things on the Fed maintaining low interest rates and on the belief that the Fed is an anti.
Whoops. Sorry about that, folks. It looks like, we had some technical difficulties. It happens every once in a while when you're relying on that thing called the internet and Wi-Fi connectivity. It would seem that as much as we like to talk about our disruptive technologies and connected society investing themes, that sometimes, they do let us
Sometimes
down.
disruptive technology is disruptive.
I couldn't have said it any better, Lenore. So I believe what we were talking about was the windup of the Fed, the testimony in front of Congress by Fed Chairman Jay Powell. And we were kind of wrapping it up saying, look, he's been saying a lot of things. The underlying data doesn't necessarily support some of the commentary. The market is reading his commentary as, more likely to have more Fed rate hikes than the expected three, or maybe even fewer, depending on what was going on. And we were right about the point where I think I was about to say something along the lines of Powell brought out the Yellen playbook when he said the path of monetary policy will depend on the economic outlook as informed by incoming data. Which means that despite everything he had to say, if the data comes in softer than expected, like the SESI is pointing out, odds are we could see that now expectation for potentially 4 rate hikes get dialed back to 3. Do you agree?
I think that's a possibility.
Yep.
But my take is Powell is more concerned that inflation, because I think his school of economic thought really believes if you get wage pressures, you get inflation.
But we haven't seen that.
Exactly. But he's afraid. I think his school, because it all, all of this is just theories. It's
absolutely.
There's no science to economics. It's much more art than anything.
That's why you don't get a Bachelor of Science.
Yeah. I think his view believes that the tax stimulus and what we've seen with regulation, it is going to create wage pressures. Even if we don't see the evidence yet, I think he is much more inclined to believe, it's coming, transitory reasons we're not seeing it. And I think he's really afraid of having inflation get away from him because he's been a bit more hawkish than others, and that he may want, because if the problem with inflation is when you start seeing inflation kick up, it's already gotten away from you and it's a little too late.
So what you're saying is his fear
is belief, at least.
Right. His potential fear coming into a new job, being the guy, the person, is that he is suddenly behind the curve.
That he may be a little bit behind already. I mean, the amount of stimulus that it's tough to look at that balance sheet for the Federal Reserve, all the assets they bought, all those mortgage-backed securities, all the treasuries. Look at just how massive that is and how long we've had these super low interest rates, and not be a little concerned that that there's going to be pain. That there's a, talk about a side effect, that there's going to be some bad side effects for that. And I think he's going to want to err possibly on the side of jumping before you see a lot of data confirming that we're having a serious price pressure.
It's possible. I was listening to you and I was just thinking that, it's very rare that we see a Goldilocks ending, right?
Well, as in never.
Yeah.
In history, it's never happened. Every single time the Fed hikes us into a recession. Not saying that the Fed caused it, but you can't say, because the only way you could say for sure would be to actually do the entire thing all over again, exactly as it was, and have the Fed not hike. So
I don't think so.
The Fed hikes, and pretty much every time you get a new Fed chair, they raise rates and boom, recession.
Yeah. So it's if I hear what you're saying, there may not be direct causal. It might be
Could be
coincidental.
more timing. Yeah, it
Yeah.
could be.
Okay. Okay. Well, we'll see. We'll see. I'm suspecting that given the way the market is reacting, that to me, this whole thing coming out of the first day of testimony reminds me of the pullback that we saw in stocks back in May of 2013, when Fed Chairman Bernanke described conditions when the Fed would consider
Yeah.
tapering QE, a very big overreaction. Um, so we'll see. We'll see. But that's what I think what's happening. I think what's fascinating, but I'm not surprised, is that when we look through his comments using our thematic lens, we can actually see what's really going on and
Right.
understand that there might be some, as you put it, some concerns in the marketplace about what Powell is thinking. But it's fascinating to me how the market interprets that in a very negative way.
Or at least it did yesterday.
Or at least it did yesterday. Very well said.
On
Very well said.
Tuesday, it did.
All right. Well, this is kind of a little different episode of Cocktail Investing, where we kind of again focused on Jay Powell and breaking it down. When we come back next week, we'll be talking a lot more about, of course, what's going on in the market, the economy, but we'll be back to some thematic signals and maybe a few other surprises along the way. So thanks for tuning in, and we will catch you next week.
Have a great week.